Good day, ladies and gentlemen, and welcome to the Q2 FY23 earnings conference call of Niyogin Fintech Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sonia Keswani from Ernst & Young. Thank you, and over to you, ma'am.
Thank you, Michelle. Good evening, everyone. On behalf of Niyogin Fintech Limited, I welcome all of you to the company's Q2 FY23 earnings conference call. I am Sonia Keswani from Ernst & Young IR practice, and we manage investor relations for Niyogin Fintech Limited. You would have already received the Q2 FY23 results and investor presentation, which is also available in our filings with BSE. To discuss the company's business performance in the quarter gone by, we have with us today Mr. Dashwinder Singh, Chief Executive Officer and Managing Director, and Mr. Abhishek Thakkar, the Chief Financial Officer of Niyogin Fintech. Before we proceed with the call, a disclaimer. Please do note that anything said on this call during the course of the interaction and in our collaterals which reflects the outlook towards the future or which should be construed as a certain forward-looking statement must be viewed in conjunction with the risks the company faces and may not be updated from time to time. More details are provided at the end of the investor presentation and other filings that can be found on our website www.niyogin.com. Should you have any queries or need any further information at the end of this call, you can reach out to us at the email addresses mentioned in the company collaterals. With that, I would now like to hand over the call to Mr. Dashwinder Singh. Thank you, and over to you, sir.
Thank you, Sonia. Let me start by thanking all of you for joining us this evening. Good evening to everyone. I welcome you to Niyogin Fintech's earnings calls for Q2 FY23. Before I delve into the performance, I do hope all of you have had a very happy Diwali. I would like to offer my condolences to all my investors from India for our cricketing performance today, and for the investors who've dialed in from the UK, congratulations on winning the match today. I'm delighted to welcome Abhishek Thakkar to the Niyogin family as the new Chief Financial Officer. He comes with an experience of over 10 years in the financial sector and has been associated with the Vendors Capital, Aegis Logistics and Deloitte in his previous role. I'm also pleased to welcome Trivenika Awasthi, who will be heading our investor relations at Niyogin. She has over 10 years of experience across functions like wholesale lending, investment banking, and investor relations, and has worked with organizations like L&T, Yes Bank, and Equirus Capital. I'm confident that both Abhishek and Trivenika will be instrumental in ensuring best outcomes for the company, and I wish them success in this role. Moving on to give you a little brief on our company, Niyogin Fintech operates on a tech-centric platform-based model, wherein our banking-as-a-service platform serves both rural and urban India through a partnership-led strategy. Our partnership-led strategy allows us to tie up with local MSMEs and other enterprise partners that have a large and deeply penetrated distribution infrastructure. The BaaS, or the banking-as-a-service platform, is then employed by these partners in their customer-facing touchpoints that enable these touchpoints to provide banking, payment, and financial services to their local customers. Moreover, our partner-led strategy helps us reach out to a large number of SMEs through every partner we onboard, and that gives us a cost-efficient market access by reducing the customer acquisition cost. We can then incrementally add products for the end customer, all the while providing income augmentation for the partners and retailers. Our revenue model is primarily transaction-led, wherein we earn a fee or a commission for every transaction that is routed through our platform. From our customers' perspective, we've been concentrating on 3 market segments. Number 1, we have the business correspondents, wherein we are offering the tech stack to promote financial inclusion. Number 2 are neobanks or fintechs, typically newer companies wanting a full-stack neo-banking platform. And third are banks. Herein we work as a technology service provider or TSP with banks to launch digital programs. FY23, which is actually the first year of our 3-year plan, which I've detailed in my previous calls, is the year of build for us, and we have remained focused on our task at hand. Over the last couple of months, we have built tremendous traction on all 3 segments that I mentioned above, and are now seeing the surge in volumes as a number of our enterprise customers are going live with our platform. Each of these relationships have the potential to substantially be a game changer for our company. We are particularly focused on the unit economics because the enterprise customers and the resultant contracts have significant larger gross margins in the range of 70 to 80% as a result of minimum transaction costs. Post the initial resource build, we expect the business model to have significant operating leverage at the EBITDA level. Our business model is distinctive in nature as we serve both retail and enterprise customers and have the adaptability of a balance sheet that can support our customers as and when necessary. Talking now of the quarter gone by, we continue to expand our footprint, launch new products, and ink new partnerships. Our partner retail footprint grew 15% quarter on quarter from close to 328,000 to over 378,000. The gross transaction value, which is GTV, grew by 9% quarter on quarter as we transacted over 2,940 crores worth of transactions on our network in this quarter. We further transacted over 77 lakh transactions in this quarter, up from 72 lakhs in the Q1 FY23. September was the first month when we crossed our 1,000 crore GTV milestone, and we think the next quarter will show the first signs of J-curve as the enterprise clients have now started to scale. This is evident from the GTV numbers for October that came at almost 1,250 crores, which is around a 21% jump over September numbers. So that's a month-on-month jump between September and October of 21% on GTV. What is more heartening to note is that we are increasingly gaining recognition in our customer base as the go-to partner for our technology architecture aimed at delivering financial inclusion products. Our relevance in this space was further endorsed by MPCI, which is the National Payments Corporation of India, which has enrolled iSerview, our subsidiary, as a certified partner. iSerview was also formally recognized by MPCI at the Global Fintech Festival held recently in Mumbai as being the first technology service provider to go live with BBPS. I would like to highlight some key wins and developments for the quarter. We onboarded one of the largest PSU payments bank on AEPS, Micro ATM and IMPS switch and the agent management system that we have. Another large PSU bank has chosen iSerview's Aadhaar payment stack to run its Aadhaar Pay program. A key thing to note here is that onboarding just one or two PSU banks as partners opens up multiple opportunities for us to work with more PSU banks in future. Continuing with the highlights, our agency banking solution, which happens to be India's first scale-at-demand cloud-native technology for the same, has been chosen by a major private bank to run its correspondent banking program. iSerview has also been selected in the Finclusion program, which is an initiative by Department of Post and India Post Payments Bank to digitize the erstwhile money order service. On the tech build, iSerview team developed a proprietary biometric fraud detection method using AI techniques. This solution was a finalist at Google Cloud's hackathon. The business build has been in line with our expectations. However, we saw some slowdown in our revenues this quarter. The consolidated revenues were muted with a marginal drop quarter on quarter on account of shortage on availability of devices. While the situation is expected to improve in the next few quarters, we have taken a few steps to make sure that our business growth is supported. The platform has been modified to allow for integrating existing devices that retailers may have procured from other suppliers, and to some extent it makes our platform more open architecture. We are also trying to jointly bid with a few manufacturers for some of the large device contracts. On a GTV basis, we reported an increase of 40% on a year-on-year basis, and revenues grew 33% on a year-on-year basis on a ex-device sales basis. I do want to highlight that the growth in our fees and commission income, which was up by almost 11% quarter on quarter, was in line with the growth in our GTV, which was up 9% on a quarter on quarter. This is important because as we hit the J-curve in GTV, a major portion of our revenues will be primarily transaction-led. On the urban tech side, the new digital lending guidelines have created an incremental opportunity for us, and we are working to develop solutions to help take advantage of this opportunity. We think of lending as an important adjacency to our business, and coupled with our technology solutions, it provides a unique capability in the market. Over the next few quarters, you will see this scale up in a calibrated way, and the loan book will incrementally contribute to our numbers. To give you a little sense on the guidance for the upcoming years, as an API infrastructure provider with lending capability, we continue to remain excited by the potential of the market and the ecosystem we are operating in. As mentioned earlier, we are targeting to be a 500 crore revenue company in FY25. We are on the path to increase our GTV from approximately 9,000 crores in FY22 to over 1 lakh crores in FY25. Grow our partner BC agents or touchpoint 6 to 8 times from close to about 247,000 in FY22 to between 1.5 to 2 million and we expect to deliver 10 to 12% EBITDA in the said 3-year period. With that, I will now hand over to Abhishek to take us through the financials and other details of Q2 FY23. Post that, we can open this up for questions and we can address all your queries. Thank you, and over to Abhishek.
Well, thank you, Josh. Good day, everyone. I'll first run you through our operational metrics and then we'll run you through the financials. Our operational metrics have continued to perform well in the quarter gone by. In rural tech, our VC partners grew 35.3% year-on-year and stood at 701 in Q2. While our VC partners, agents or touchpoints increased to 378,500, reporting a significant growth of 90.6% year-on-year as we added close to 50,000 new retailers in Q2. Gross transaction value, that is GTV, including the payouts, stood at approximately rupees 2,943 crores, an increase of 40% year-on-year. Transaction volume stood at 77 lakhs, up 28.3% year-on-year. On the urban tech front, our partner count increased by 9% year-on-year and stood at 5,051 in Q2 FY23. Our web tech platform continues to perform well and recorded 59.5% year-on-year growth in the AUM, which stood at rupees 2,910 crores. Moving on to the financials for Q2, our consolidated revenue for the quarter was rupees 26.5 crores, an increase of about 2% year-on-year and dropped 3.6% quarter-on-quarter due to the shortage on availability of devices. Adjusted EBITDA, excluding the ESOP charge, which is non-cash in nature, for the current quarter was negative rupees 6.8 crores as against a positive of rupees 0.8 crores in Q2 of last year. As explained by Tash earlier, we are currently in a period of build which is leading to higher operating expenses, hence the said change. ESOP charge for the current quarter was rupees 1.6 crore versus rupees 1.3 crores in the corresponding quarter last year. The non-GAAP PBT stood at negative rupees 8.3 crores in Q2 of this year as against negative non-GAAP PBT of 0.5 crores in the corresponding quarter last year. Loan book net of provisions stood at rupees 51.2 crores. We continue to remain a zero debt and net cash company. Our cash in hand stood at rupees 90.3 crores as of Q2 FY23. With that, we can now open the floor for questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may press star and 1 to ask a question. Participants who want to ask a question may please press star and 1 now. Anyone who wishes to ask a question may please press star and 1 now. We have the first question from the line of Concall from Compound 26 Capital. Please go ahead.
Hello.
Yeah, hi Pawan.
Yeah, please proceed.
Hey, Tash. Okay. Just a clarification. In your profit and loss statement, where I see the income of about income from commission and fees expenses and the expenses, can you just clarify that for me? What those are?
Sorry, could you repeat that question? I missed you.
Sure. So in your financial statements in the profit and loss account, the income side, the income and fees, commission expenses, income and expenses. So can you clarify? So what is this income, and against that, what are the expenses that you incur?
Yeah, that's a fair question. So what happens in two businesses come into contribute out here. Firstly, I'll talk about the rural tech and then the urban tech. On the rural tech side, what happens is that we'll end up working with partners who bring in their retail front points, right? So take an example of large aggregator like a Hindustan Lever distributor or whatever, who may have access to 10,000 or 20,000 retail points. We work with them and we then deploy our technology across those 15, 20, 30,000 retail points. Now, as transactions get done on those retail points, right, we get paid by either the bank or by the person who's initiating the transaction, depending on the product. So if you use a micro ATM product, in the micro ATM product, the bank pays us commission for enabling the customer to get access to his or her bank account. And then we share some of that commission we get from the bank, we share it with the retailer and the partner. So the expense is really the sharing of that commission. The income is what we are receiving from the bank. Similarly, in the lending side of the business, how we have built out so far, and I think the digital lending laws have now come in, which have changed a few things, but there were some of the FLDG-related transactions that were being done where we were lending on behalf of other fintech companies. And there again, since they were covering us on the risk, we were paying them a commission for covering us on the risk, right? So the income that we were getting would go in the interest income, whereas the commission that we would pay them would go into the commission expense.
So let's say for this quarter, for example, you had a fee and commission income of 15.9 crores and you had an expense of 16.1 crores against that.
Right.
So is there a fixed component against this, or is it all variable?
No, so this is there is no fixed component. The way to analyze this number, Pawan, is you should add the interest income also into the fees and commission, because part of the interest income that we earn on the lending book, we are paying that as commission to someone who's covering us on the risk, right? So the way to look at the number is to add both and then arrive at it, right? And this is a completely variable expense. There is no fixed portion out here. It's completely variabilized, which is also part of our business model, that we've tried to keep most of our expenses as much variable as possible so that we don't have the problem, right? Of course, people expense, etc. is not variable, but on the commission side, it's completely variable.
So then to look at it as 22 crores of combined income versus an expense of 16 crores, and
that's right. That's right.
Gives you a gross margin.
That's the right way to see it.
Okay. Understood.
Yeah.
Second question is, I know you were focused more on recruitment of talent over the last couple of quarters. What's the aim and objective for kind of the rest of the year that you look at? Are there more organizational recruitments that you want to do, or is it where you're kind of focusing your time on for the next year, 2 years?
So what we've done, Pawan, is as you would know, we had invested 50 crores on the 28th of March into our subsidiary IceReview, because we've created our 3-year hyper-growth plan in that business, which I had shared with you, right? Now, the first, and we've only invested 50 crores of the 100 that we had sought approval for and got approval for. We think the 50 crores, we may not need to invest too much more money, because most of the build that we needed to do has been done in the first 6 months. So what we spent the first 6 months of the year doing is we built out the entire team. We built out the tech teams. We've got our premises sorted. We've got whatever IT we had to build, we've built it out. And therefore, this first 6 months have been a year of a build. I think the only hiring that will happen now, between now and the next 6 months, is really going to be replacement hiring if we lose people and therefore we need to replace them. The build of people, the increase of people, I think we are pretty much done with. I don't think we need to hire more talent incrementally to build the new propositions, right? Most of the new propositions are either in the final stage of build or have already got implemented, which is also the reason why we are now seeing the surge in volumes, as I explained on my presentation, that typically last quarter we did about 2,700 crores. This quarter we did about 2,950 crores. And in October alone, we have done about 1,250 crores, right? So if I just go by the October 100, you're talking about getting to almost 4,000 crores in this quarter. Of course, we'll see what that number comes to eventually. But the idea is that the J-curve on the volume is now coming in because the incremental products have all been launched, right? And there is obviously some more development that's happening, and we will keep doing that, keep improving the quality of our products and the delivery. But I don't think we need to hire incrementally material resources.
How much of the jump in October could be attributed to seasonality, like Diwali season and stuff like that?
Yeah, so there will be some level of seasonality, right? I would put almost 100 crores of the October uptick in the volume would be coming in because of seasonality related to Diwali. But what's also happening is that towards the end of October, 2 or 3 of our enterprise customers have just gone live. So you don't have the full contribution of their volumes in the October numbers. So my submission is that in the month of November and December, we will see those enterprise customers scaling up, and they will make up for the one-timer that we might have had in October because of Diwali. So we feel pretty good about the way the business is scaling up, right? There are 4 large enterprise customers that actually went live in October. One large enterprise, and I've mentioned this in the past, India Post is now one of our big customers. We went live with India Post in September. So that's good. That scale-up will also happen in the course of this quarter. So that's why we feel good about the fact that the products have been implemented, tested, and there are real transactions happening on our platform by these partners.
Got it. And in terms of in the balance sheet, you mentioned there is about 90 odd crores of cash. So are you still looking at M&As at the moment?
We've got 90 crores of cash.
Is that also something in focus?
So above, we've got 90 crores of cash.
Yeah.
90. And I think what we're trying to do is there are some interesting, there is a fintech winter in the market, right? You know that. So there are some opportunities that are coming our way. But I don't think I want to capture a falling knife, right? I don't want to take a business that's pretty much shutting down or in trouble, right? We're looking at some very interesting businesses that we think have strong legs, and we can come in and provide some capital to them, and see if those can be acquired. Those could be interesting M&A opportunities for us. So we are being very, very selective. We want to look at M&A opportunities which are obviously bolt-on to the business lines that we currently have. I don't want to do an M&A on a completely random business line, number one. Number two, I think we do also have the opportunity of, the digital lending guidelines that RBI came out with has created an interesting opportunity for people like us, which are actually both NBFCs and have fintech capabilities of delivering lending solutions. So I think the capital that we have on our books, we will use some of it will go into the lending book and some of it will be used to continuously keep exploring and seeing if some M&A comes up. So there are a couple of conversations we're having, but nothing which has come to a stage where I can sort of announce or talk to the street about it getting done.
Okay, got it. Okay, thank you so much.
Yeah. Thanks.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may please press star and 1 now. We have the next question from the line of Yash Modi from Ashika Group. Please go ahead.
Hey, hi Tash.
Hi Yash, how are you?
I'm good, Tash. So Tash, firstly, congratulations on the October throughput. You'd always guided us that Q2 would be some place where you would be building, and from Q3 onwards, the enterprise customers would be setting in. So just wanted some more color, if you could give us more color on how the relationship with India Post Payment Bank is done. I'm guessing the public sector payments bank that you've mentioned in the slide is obviously India Post Payments Bank, and you've obviously gone live with the MATM, AEPS solutions, and as well as you were designing the money order thing for them. So just wanted more color, if you could give us more color, how that relationship is scaling up.
Yeah, so I think firstly there's more than one PSU bank. I'm sorry, I'm not at liberty to take the name of the other bank, but that's a large bank that has given us a mandate to provide the solution of Aadhaar Pay for them. Okay. India Post, obviously, I have announced in the previous calls as well, so yes, clearly you know about that. I think we started the business with them started towards the last week of September when we went live, and October's been the first month where they've actually really started pumping volumes through us, which has been very, very heartening. I think you will see that these things take about a quarter for them to really get to a stage where they become really material. I think this quarter, November, December are important for us for that one partner, but I would also say there are 701 partners we have. It's not just one partner. So the scale up is happening because we are getting multiple partners who are coming and talking to us, right? Number two, what's happening in the market, and I did mention this in my letter as well. I don't know if you had a chance to go through it. What's happening is there are a number of players who are operating in the financial inclusion place, right? These are partners, large players who are competitors to Spice Money or Pay Nearby and other people. A lot of them are coming to us asking us for our tech solution. So we've become, in some sense, the go-to partner for anyone who wants to work in these products, right, as a tech solution provider, right, as the API infrastructure provider for them. And that's great because we also now have the switching capability. As I told you, we built that out. Correct. So with the tech solution, along with the switching capability, we are able to provide a fully integrated solution for someone who wants to just get into financial inclusion can just do a plug-and-play approach with us. So that I think is turning out to be interesting, and that's the reason why we are finding a lot of enterprise partners are now lining up with us. There is some level of integration work that's required to be done, but the flash to bang or time to market is not significant for some of these partners now that the solution is pretty much available like an off-the-shelf solution with a little bit of integration required. So I think you'll see that numbers, you'll see the scaling up happening of these partners. October is really one month, but Pawan was right in his comment that there is obviously the tailwinds of a Diwali season, etc., that comes in, where people do more money transfers and people do spend more and withdraw more cash and all of that, right? But we've seen, if I just look at the numbers of new partners that have come in, it gives me a lot of confidence that the next couple of months will be, and thereafter all quarters will start showing significant uptick in our volumes.
Sure. And if I look at it, obviously you've mentioned in your letter as well as in the balance sheet showing in the cash in the income statement showing that device sale was minuscule this quarter, around 1.7, 1.8 crores.
1.7 crores.
Yeah, 1.7 crores. So assuming we've done 26 crores this quarter, so 25 crores on a throughput of around 3,000 crores. If we are able to say maintain a run rate, the throughput run rate that we are maintaining in October, so would it be fair to assume that it like if we do 4,000 crores throughput, it is in my modeling, can I assume 60-70 bips on that plus the device sale? Would that be the correct way to look at it?
Yeah, I think that's the right way to look at it. I would probably be a little more conservative and take it at 50 bips rather than 60-70 bips, right? Just as we scale, because as we are scaling, we're also offering some incentives to people to come to us and all of that. So I would take a slightly more conservative view, and the device sales revenues will also come in, because if you look at last year, same time, we did almost 8 crore plus of device sales.
Correct.
If we had done a similar number, then obviously the growth would have been quite material to us compared to last quarter, right?
Correct.
So those numbers are going to come back. What's happening is we are finding that on the device sales side, earlier on, it was a little bit of people buying devices, giving us small orders, etc. The bigger players are all running contracts and running bids, right? And because supply is an issue, what we've done strategically is we've tied up with a couple of manufacturers to jointly bid. So the manufacturers then make sure that the supply is available because these are larger contracts, but everything gets billed through us because it's our contract. We are providing the technology along with the devices. So you'll hear about some of these in the next quarter. Hopefully, we'll be able to talk about maybe one or two large transactions we would have been able to consummate, right? And because we are in the bidding process, I can't really talk about them, but we've actually submitted bids for a couple of these large contracts, and these could all be in the ballpark of 10, 15, 25, 30 crores kind of thing. So they are very, very significant game changers from a top line standpoint, right? Obviously, they are profitable because there is a margin that we take on each of these. So once one of those things come back, I think the numbers will look good. But more important to mention is that I think the transaction scale up and the transaction revenue scale up, I think, is the way our business should actually get measured. Because devices sales will happen in a quarter, may not happen in a second quarter. But as long as the transaction volumes are scaling up and the transaction revenues are scaling up, I think that's what really drives our business momentum.
Correct. No, I was asking this question more in terms of if we've gone live with India Post Payment Bank in September end. So I'm assuming that most of the postmen who would be using our services for won't be having any devices because they would have never done something like an MATM or a AEPS. So I think from that itself, there can be a big kicker on if we are able to provide devices. And unlike some retail storefronts where devices might be available, some fintech player might have tapped in, which would be more part of our open architecture that you were talking about, wherein we'll use our solutions to actually give our services on devices that they already own. India Post Payment Bank postmen would be probably absolutely new devices for all the postmen.
I think you're absolutely right. I think that's also one of the reasons why we've made our platform open architecture, right? Because we don't want to limit that only our devices can be used on our platform, and we made that development this quarter as well, where people who are working with other partners, other players, right, and want to move to us because either our technology is superior or our commercial understanding is better, they can move in without necessarily having to buy new devices, right? Because that makes it more efficient for retailers to then move to us. So we've done a bunch of that. On the India Post side, you would expect that large players like India Post would run tenders, etc., for devices, right, rather than just give it to one partner, right? So one service provider. So that's going to happen, and you're right. The opportunity is quite humongous. It's not going to get realized in a month or two. It will take a couple of quarters to realize the opportunity. But as long as the scale-up is happening in the right way, and it's pretty significant. Unfortunately, I cannot share individual client-level data on what volume we are doing because there is some confidentiality there. But I can show you that the overall numbers are going up. It's because everyone is going up, right? So all the partners are scaling up in some form or shape.
Got it. Just one more question from my end. So one of our customers / competitors, one of the small payment banks who's listed, namely obviously Fino. So in their Concall, they were referring to the fact that going forward they are seeing some pressure on the MATM side, AEPS side in terms of volumes, because they're saying that competition is increasing. Earlier they used to have kind of monopoly in the space, and they are getting more and more margins from their CMS and their CASA business.
Right.
So it probably would be safe to assume that other payment banks would also be going the similar way, wherein they would be starting up their CMS business, cash management services business, in a big way, trying to garner CASA. So I remember you'd given us a good picture of the kind of new services that you were looking to start, wherein you were talking about railway ticket bookings, CMS, stuff like that. So where are we in terms of that build? If you could talk about that part of the business a little bit.
So sure. So firstly, I think Fino in their Concall, like you rightly said, talked about flattening of volumes in some sense, right? I think what's happening is, firstly, they're a bank. We're not a bank. We are a technology company that is providing technology to people who are competitors to Fino, right? So we don't compete with Fino, but our customers land up competing with Fino. So I think that's one distinction you should draw. So because Fino will have their own retail outlets or their own sort of branch locations or BC locations, etc., providing these solutions, whereas we will be partnering people like India Post, or could be people like CSC, or could be people like Bhafin, etc. They will be using our technology, and they would land up competing with Fino on the street. So to that extent, what happens is that my marketplace is significantly bigger. My universe of customers that I can deal with is significantly bigger because I'm seen as a technology service provider. I'm not seen as a competitor to Fino, right? So that's point number one, which I think is important to mention, right? Number two, that is just on the financial inclusion stack, but there are incremental product propositions that we have. For example, we have launched a prepaid card solution. There's a full-fledged prepaid card solution where somebody who wants to launch a prepaid card solution into their network, whether it is to deliver some level of commissioning that they want to give through prepaid cards, or they want prepaid cards to be issued by retail solutions, retail front ends. We have the full stack that has been created for that. We have 2 customers with whom we are doing this pilot, and hopefully by next quarter when we talk, I would have gone live on the prepaid card solution as we speak. On the IRC ticketing side, we are still doing the integration, but we hope to go live very soon on that as well. So you will have postmen who will be able to deliver tickets on handheld devices to customers on the ground, right? So it just changes the scale of how things are going to get done, right? It all requires technology and it requires a build. And I think our vision is to provide that, to be the go-to person for all these tech stack solutions. We don't want to be the final entity owning the retail store, because that leads to a different expense structure. But we want to be the person, anyone who has a significant retail front end, wants to do anything to do with financial inclusion or any financial solution, they can come to us, because we are now today beyond financial inclusion. Financial inclusion is just people getting access to their bank accounts. But when you talk about insurance, when you talk about ticketing, when you talk about prepaid cards, etc., these are not financial inclusion products. These are just financial products. So we have expanded our capabilities beyond just financial inclusion. And now what we're trying to do is we're trying to make sure these new products also sell into the network, right? And our existing partners, which is the 701 partners that we spoke of earlier, they could potentially pick and choose whatever products they think are appropriate for their ecosystem, right? So we want to be the entity that has all the products available on the shelf, and you can pick and choose what you want to use to deliver across your retail network. There are 63 million retail front ends in the country, right? So the opportunity set is huge on what you can finally get to.
Got it, Tash. Thank you. So actually, Fino saying that competition is increasing is actually better for us. Shows that our market size is increasing.
Yeah, it is. And that is also the reason why you are seeing our volumes are going up, because my volumes are the cumulative set of volumes of all my customers, right? Whereas Fino's volumes or any other competitor's volumes are going to be the volumes of them alone. So obviously I have multiple people who are using my technology, and as I mentioned, I've got 4 or 5 very, very large partners who have now signed up with us. And just the 4 partners that we've signed up could give us an incremental volume of 500 crores per month, right, once they go live. So these are not small numbers, these are pretty significant numbers. If I'm at 1250, if the 4 new partners alone can contribute 500 crores, we're talking about getting to 1750 in the course of the next couple of quarters or so, just with this. And the existing partners will also scale because they're all scaling, adding more retail points. More retail points are getting activated. So you'll see all that happening, right? So I think we are getting, like I said, that's why I went out on a limb, and I told you that we are seeing the first signs of the J curve for our business that we've been waiting, and our expectation was to get it around this time, because if you don't have the build in place, then getting the J curve would actually be disastrous for us. Today we have the build, we have the stability, we have the switching capability, we have the product capability, and customers are now tasting us, checking us out, seeing that we have the ability to handle the volumes that they want to get, right? So we spoke about the number of transactions that were done, 7.7 million transactions on our platform, and the capability is to do multiple of that.
Got it. And how are volumes scaling up on the switch part of the business? Just the switch part, the switch that you went live with.
So switching capability, it's an option we provide to our customers. Not every transaction goes through our switch, because some customers, for example, certain banks we work with, they have their own switching capability. So they want to use our front end, but they want the transaction to be routed to their switch. So the switching and our switching capability, in all fairness, is relatively new, right? It's only been over a quarter and a half that we've sort of had a switching capability. So the volumes will keep going up. The switching capability is important because we are able to charge for switching separately as well. But I think we will see incremental volumes coming in, as the new partners who are coming in, which are not bank partners, but financial inclusion partners. With all of them, they're using our switching capability. So we'll see the scale up on our switching capability also happening, as we speak, as time goes by. But right now, the transactions do get divided between transactions moving through our switch and some transactions moving through the bank switches, depending on what the arrangement is with the enterprise partner.
Got it.
So
Thank you so much.
Example of India Post, for example, India Post has their own switching. That we build the switch for them, right? We build the switch for them, but it's their switch. So their transactions will go through their switch. There is no need to transfer their transactions through our switch. But if you look at Bhafin, for example, again in Bhafin's case, I think we are using the IndusInd switch. But if you look at
HESA, for example, HESA, the agri-tech.
Yeah, HESA, for example, is using our switch. Yeah, absolutely. Good point. So HESA, which is the agri entity based out of Telangana, they use our switch. Right. So we are moving, and my motivation is, quite honestly, the vision is to move as much as possible through our own switch. Because it does 2 things. One, I think it improves the client experience because we have control over that switch. And number 2, obviously, it is economically more beneficial for us.
Got it. Thank you so much, Tash. All the best.
Thank you, Yash.
Thank you. Before we take the next question, a reminder to all the participants, anyone who wishes to ask a question may please press star and 1 now. We have the next question from the line of Subrata Sarkar from Mount Intra Finance. Please go ahead.
Hello.
Yeah.
Yeah. Sir, I have a very simple question. Like in our rural tech business, at what point of turnover can we attain EBITDA, at least EBITDA level profitability or break even? And if you once more explain us the rural tech business model, basically what is the total at what 100 rupees of revenue, how much will flow to us and the breakup of that.
Okay. So let me answer the second question first, right? Our rural tech business is focused on, the whole vision was driven by, in the Jan Dhan Yojana proposition, the government of India created bank accounts for 430 million people. 430 million new bank accounts were opened. But I think nobody thought through how these accounts will be served. And I think our motivation when we started this out was to look at how can we provide services to these customers who could be potentially largely in rural locations. There are 800 million people that live in rural India of the 1.4 billion population. And a large portion of these accounts that were opened were predominantly in rural India. And I think the motivation was, as we spoke with banks, as we spoke with other partners, etc., The idea was to try and create a proposition which could provide variable costing to banks, and then use the existing infrastructure that exists on the ground rather than create new infrastructure. Now, existing infrastructure, I mean retail stores, etc., kirana stores that exist, and use them as channels to be able to deliver the banking solutions rather than asking banks to start creating new branches. Because all the new branches banks create in smaller locations, tier 2, tier 3, tier 4 towns, tend to generally be loss-making, right? So, I mean, that's just tend to be. I'm not saying 100% of them are loss-making. So, the idea was that how do you take the fixed cost away from a bank standpoint, convert that into a variable cost, and then also get paid in that whole equation, right? So that's what I think the proposition was, and in the bargain, also create an income augmentation proposition for the retailer, because if the retailer is providing an incremental service, he needs to get paid, and therefore provide convenience to the end consumer who's able to access his or her bank account without necessarily paying for it, without having to need to go to travel to some banks, etc., and so on and so forth, right? Now, the way it works is there are multiple products that get used up in this proposition. So I'll give you the top 4, 5, 6 products that are used in this proposition, right? This whole financial inclusion started by giving access to bank accounts, which basically meant that customers should be able to withdraw money from their bank account. And solutions like micro ATM and AEPS, which is Aadhaar-enabled payment systems, were the two solutions that were provided by the India stack to be able to deliver this to customers. In both the solutions, the customer could walk into a kirana store, would have a small device for authenticating the plastic, which is the ATM card, or you could walk in without any plastic and just use your fingerprint and your Aadhaar card number to be able to withdraw money from your bank account. And providing that linkage from the kirana store all the way to MPCI and to the banks, we were providing the infrastructure for that. We were providing the technology to be able to do that. So, and it's a very simple, straightforward, because once you work in rural area India, you realize you can't create complicated solutions. You need all the security matters, but the solution and the front end and the user experience has to be very, very simplistic. So we build that front end ourselves, and we are one of the players that's been delivering that to people who want to provide that. Now, we don't deal with the kirana stores directly. Our strategy was that to manage our cost structure and to make sure that we don't need to have thousands and thousands of people trying to convince kirana stores to work with us, we said we will follow an enterprise strategy where we will go to people who control large front ends. So when you look at an entity like Bhafen or you look at an entity like HESA, as was mentioned on the call earlier, these are people who have access to large front ends, 15, 20, 30, 40,000 retail stores. Bhafen has almost 120,000 stores, right? E-stores. We went to them and we told them, why don't you use our technology to deliver these services through your retail stores? And that's how the solution has been delivered to multiple retail points rather than going on a retail point by retail point basis, all right, including an entity like CSE. So that's how it was done. Now, the product revenues vary on a product by product basis. In a micro ATM or an AEPS, the margin could be 40 basis points. In a domestic money transfer, it could be 80 basis points, 80 basis points to 1%. In an insurance product, the margins could be very, very significant. Could be 7 to 10% for a what do you call scooter or a bike insurance, or could be 20% for a life insurance, or even higher. So there are different products and there are different margins and there are different levels of scale in each of these products. Our eventual game is to scale everything to whatever extent we can. But that's the margin that I was mentioning, 40-50 basis points earlier, is the cumulative number that comes out by looking at all these products. If you look at the volumes that we have today, I think largely AEPS, micro ATM and DMT, which is domestic money transfers, are the three large product propositions that we have, and that's how the numbers settle. The volume at which we break even, which was the first part of your question, is actually a difficult one to answer because it varies on the product mix. If we are able to do significant levels of insurance, then the volume required to break even is significantly lower. If we only land up doing micro ATM or AEPS transaction, then the volume required will be significantly higher because the margins there are much lower. So, it's a multitude of things. Right now, we were pretty much on the stage of break even at a much lower volume. We have invested 50 crores into building this business and building new products and to build volume. So I think the reason we are having a loss right now is primarily because of all the operating costs we have taken in as we build out these products. As these products are scaling, as they get rolled out in the market, I think you will suddenly see in the following few quarters that the numbers would start looking a lot more healthier on the bottom line. Our target to the street, as you would have read in my note, is that in 3 years we think we can get to 500 crores. We think the EBITDA potential for our business is between 10 to 12% at that point in time, at that scale. Obviously, break-even will happen much earlier, but that's really the way we are going, right? Cumulatively, what will also happen is as our lending book scales up, lending is obviously a deeply profitable business. As that scales up, that will also contribute to the bottom line. So then we will be, in line with achieving what we want to achieve on an FY25 basis. I'll pause here to see if you have any follow-up question.
No, thank you, sir. Thanks.
Yeah.
Thank you. You may press star and 1 to ask a question. We have the next question from the line of Ramesh Kumar, an individual investor. Please go ahead.
Hi, sir. Thank you for the opportunity. So just a basic question. The thing is, how we are different from other fintechs because it's a crowded market. So can you just give a color on that?
So I think fintech is actually a term that is used to describe lots of companies. I think I break up the whole fintech market into 4 or 5 buckets. There is one set of fintechs that are largely into lending. There are other set of fintechs that are largely into payments. There are third set of fintechs that are getting into efficiency products, which means, they help you improve the accounting process that you do or help you improve your sales process, etc. Right? And I count ourselves in a slightly different bucket. I count ourselves in a bucket where we are working on products that are focusing on income augmentation. Our proposition, when we go and meet our customers, our single proposition is to try and talk to them about how we can increase income for you, rather than just try and bring more efficiency. We increase income from the first transaction you'll end up doing. So when you talk to a partner and you tell him that, listen, for your Kirana stores, as you implement our solution, you can make, I will give you an example, right? In a micro ATM solution, a bank pays us 15 rupees per transaction. Right? It's on a per transaction basis. So if you are able to go to a Kirana store and say that you can start doing these transactions from tomorrow, and you can earn, call it 8, 9, 10 rupees per transaction, that's a straight income augmentation on every transaction that gets done. So we provide the technology to provide a new product proposition to a Kirana store, which is able to then make money right on day one of implementing the solution. What is the investment required? The investment required at the Kirana store level is negligible. They need to buy basically a micro ATM device, which can cost anywhere between 1,500-1,600 rupees, or they need to buy an AEPS device that costs between 800 to 900 rupees. That's all. That is the only, and obviously they need to have a smartphone or a laptop to download our app. It's an app-based solution. Customers can download the app. The app connects through Bluetooth technology onto the device, and they are good to go. That's all that is required for a Kirana store to go live. Right? So the idea is to provide a simplistic solution which is simple from an execution standpoint. But because these are financial transactions, we have all the security features that are required. I mentioned, we have now our subsidiary has now been identified and accepted by MPCI as a certified partner, which is a good sort of accolade to have in our handle. So.
Okay. And then what? Who all are the major competitors in this? Like.
So I think we think of ourselves as an API infrastructure company. I look at companies like Setu, which has been acquired by Pine Labs as a competitor to us. I look at M2P, which is it's a program manager for Visa Master. I think of them as competitor to us because financial inclusion is just a set of products, right? The idea is that if you have the pipes, you can add any product onto the pipes. We want to own the pipes. We want to own the API infrastructure. We want to own that proposition. So people like M2P, people like Zeta, people like Setu, these are the people who are the competitors to us. Right? Of course, they are not very big in financial inclusion yet, but they could potentially get into financial inclusion just like we are getting into their space. We are getting into prepaid cards. We are getting into products that probably an M2P is more well known for. We are getting into their space. They could potentially get into our space by getting into financial inclusion because they are also owning a certain set of pipes, have integration with banks, etc. So from an architecture standpoint, we are similar, but from an end product standpoint, we are different, right? But the end products can change, and evolution will require each one of us to be fleet-footed in changing the product stack. So as long as we own the pipe, I think I'm pretty comfortable with the product stack changing, as and when the opportunities come in.
Okay. And can you please give us the product-wise revenue like AEPS, TMT, and micro ATM if you are handy?
Yeah, so I think we have not given that to the street yet. I think the volume-wise,
Okay.
we've basically given a clear indication to the street that typically these three are the largest products, right? They make almost about 80-90% of our GTV today. And they're all three are pretty much equal. So they're about one-third, right? I'm just giving you rounded up numbers.
Yeah, got it.
Right, so that's basically how our GTV is broken up today. But as the incremental product, as the cards starts going live, as insurance goes live, as ticketing goes live, you'll suddenly see those products also contributing to the GTV, as these products will continue to scale up as well.
Okay. And last question from my side, like what's how our hypergrowth strategy is progressing, like in which direction?
So I think it's just been 6 months, right? It's not been too
Yeah.
long for us since we started this process, and the first 6 months, as I had mentioned, in fact, the first year I had mentioned was going to be a year of build for us. Obviously, we have accelerated the build. We have hired early. We have tried to make sure that we get the build out there early, rather than the original plan that was to have the build over this 1 year. So the products are ready that we want to build. Our new, and I mentioned in my letter, if you look at some of the new products that we've built that has got accepted by, people like Google have accepted the quality of our products. So I think all that is looking good. The question that we need to really ask ourselves is how soon and how fast can we scale, right? Because the hypergrowth basically means that we should scale. And the beauty is the scale is not leading to a erosion of the margin. So we are keeping the margins the way they are, and we are scaling up, which is the right way to do this. Which is why I mentioned in my chart that you see our growth in revenues is equal to the growth in our GTV, right? On non-device sales. So that is, I think, interesting. That's how it should be. And I think the next couple of quarters are going to be important for us. I'm very, very focused on making sure that we are able to start. Because one of the things we had mentioned in the hypergrowth strategy is that we are building in a modular basis. Every time we build a product, we want to take it out to the street rather than just build everything together and then take things out to the street. So we are doing that now. We are rolling out these products that we built out, new partnerships that we've got. We've got acceptability with a lot of banks. A lot of banks have partnered with us. I mentioned breaking into a PSU bank is never easy. We've got them in because every time we talk to some of the larger PSU banks, the first question they ask us is, who else are you working with? Now we've got that window as well, which again will allow us to keep acquiring new and new customers into our handle. I think our agency banking solution is now getting accepted. That again will contribute to some set of volume. So it's interesting. It's looking good. I would be very, very focused on looking at how the next 2 quarters go. Because once the next 2 quarters are in good shape, then I think next year will just take off. That's really the way we want to build our business.
Okay. That's it from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Tashwinder Singh for closing comments.
Yeah. Thank you, Sonia. I just want to thank all of you for joining the call today. I think we continue to remain very, very focused and driven by the opportunity that we see on the ground for ourselves. I do hope you will continue to dial in and listen to our story as we keep building out, our business. I look forward to seeing you again next quarter. And if you have any questions you want to engage directly, I think the contact details are mentioned in the invite. Feel free to reach out to us. We are happy to connect and answer any questions that might be there on a one-on-one basis. Thank you.
Thank you. On behalf of Niyogin Fintech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your